Hello and welcome back to the channel. You might have heard about bonds and how they're part of any healthy portfolio. In our last video, we talked about stocks, so today we will look at bonds and how they compare against stocks. This video is part of a series for everyone just starting out and looking to learn some basic principles. So let's start with a very simple definition. A bond is a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or governmental. In our last video, we learned that when you purchase a stock, you're buying a microscopic stake in the company. It's yours and you get to share in the growth and also in the loss. On the other hand, a bond is a type of loan. When a company needs funds for any number of reasons, they may issue a bond to finance that loan. Much like a home mortgage, they ask for a certain amount of money for a fixed period of time. When the time is up, the company repays the bond in full. During that time, the company pays the investor a certain amount of interest, called a coupon, on set dates. There are many types of bonds. The most frequent are government, corporate, municipal, mortgage, or treasury. Government bonds are generally the safest, while some corporate bonds are considered the most risky of the commonly known bond types. Corporate bonds refer to the debt securities that companies issue to pay their expenses and raise capital. The yield of these bonds depends on the creditworthiness of the company that issues them. The riskiest bonds are known as junk bonds, but they also offer the highest returns. Please note that the interest from corporate bonds is subject to both federal and local income taxes. Sovereign bonds, or sovereign debt, are debt securities issued by national governments to defray their expenses. Because the issuing governments are very unlikely to default, these bonds typically have a very high credit rating and a relatively low yield. In the US, bonds issued by the federal government are called treasuries, while those issued by the United Kingdom are called gilts. Treasuries are exempt from state and local tax, although they are still subject to federal income tax. For investors, the biggest risks are credit risk and interest rate risk. Since bonds are debts, if the issuer fails to pay back their debt, the bond can default. As a result, the riskier the issuer, the higher the interest rate will be demanded on the bond, and the greater the cost to the borrower. Also, since bonds may vary in price opposite interest rates, if rates rise, bonds' value fall. Bonds are generally priced at face value, also called par, of $1,000 per bond. But once the bond hits the open market, the asking price can be priced lower than the face value, called a discount, or higher than the face value, called a premium. If a bond is priced at a premium, the investor will receive a lower coupon yield because they paid more for the bond. If it's priced at a discount, the investor will receive a higher coupon yield because they paid less than the face value. Bond prices tend to be less volatile than stocks, and they often respond more to interest rate changes than other market conditions. This is why investors looking for safety and income often prefer bonds over stocks as they get closer to retirement. Because bonds pay a steady interest stream, called the coupon, owners of bonds have to pay regular income taxes on the funds received. For this reason, bonds are best kept in a tax-sheltered account, like an IRA, to gain tax advantages not present in a standard brokerage account. If you purchased a bond at a discount, you will be required to pay capital gains tax on the difference between the price you paid and the bond's par value, normally $1,000 per bond, but not until the bond matures and you receive the face value of the bond. Now that we know what bonds are and how they work, let's go over some key terms you will need to know when looking to invest in them. Maturity is the date when the principal of par amount on the bond is paid to investors and the company's bond obligation ends. Therefore, it defines the lifetime of the bond. A bond's maturity is one of the primary considerations an investor weighs against their investment goals and horizon. Maturity is often classified in three ways. Short-term, bonds that fall into this category tend to mature within 1 to 3 years. Medium-term, maturity dates for these types of bonds are normally over 10 years. And long-term, these bonds generally mature over longer periods of time. Another important aspect is knowing if a bond is secured or unsecured. A secured bond pledges specific assets to bondholders if the company cannot repay the obligation. This asset is also called collateral on the loan. So, if the bond issuer defaults, the asset is then transferred to the investors. A mortgage-backed security is one type of secured bonds backed by titles to the homes of the borrowers. Unsecured bonds, on the other hand, are not backed by any collateral. That means the interest and principal are only guaranteed by the issuing company. These bonds return little of your investment if the company fails. As such, they are much riskier than secured bonds. Staying on the topic of risk and failure, when a firm goes bankrupt, it repays investors in a particular order as it liquidates. After a firm sells off all its assets, it begins to pay out its investors. Senior debt is debt that must be paid first, followed by junior debt. Stockholders get whatever is left after. Another key term when looking at bonds is the coupon. The coupon represents interest paid to bondholders, normally, annually, or semi-annually. The coupon is also called the coupon rate or nominal yield. To calculate this rate, divide the annual payments by the face value of the bond. Now that we have a basic understanding of bonds, let's look at how we buy them. Most bonds are still traded over the counter through electronic markets. For individual investors, many brokers charge larger commissions for bonds since the market isn't as liquid and still requires calling bond desks in many buy and sell scenarios. Other times, a broker-dealer may have certain bonds in their inventory and may sell to their investors directly from their inventory. If you want the income earning power of a bond, but you don't have the funds or don't want to own individual bonds, consider a bond ETF or bond mutual funds. These are well-diversified funds that give you exposure to many different bonds that pay a monthly or quarterly dividend. Because some bonds have a minimum purchase amount, smaller investors may find these products more appropriate for their small amount of capital while remaining properly diversified. To sum up, most investors, regardless of age, should have at least a small amount of their portfolio allocated to fixed income products such as bonds. Bonds add safety and consistency to a portfolio. Although there is a risk that the company may default and cause a large loss, investment-grade bonds rarely default. However, along with this safety comes a lower rate of return. This is it for today's video. If you like the content and want to support the channel, consider subscribing to my Patreon. The link is below. You can also help the channel grow by hitting the like button and subscribing. This was Money and You. Thank you for tuning in. Have an excellent day.